Okay, good afternoon, everybody, and thank you for joining this InvestEngine webinar in partnership with Xtrackers, which is all about the renaissance of equity factors. I'm Andy Prosser, I'm the head of investments at InvestEngine, and I'm joined today by Sturmius Schneider, who has an incredibly long title, but let me give it a go. He is a senior passive product specialist of index strategy at Xtrackers by DWS. Did I get that one right?
Correct, yeah.
Good stuff. Okay, in terms of the plan for the webinar, it's going to be a bit of a Q&A. So I've got a few questions which I think people will likely want to know the answers to. So we'll start off with some of those. But I'm also going to be picking questions from the Q&A as well at the end. So if you do want to ask questions as we're going through the webinar, you can click on, there should be like a little Q&A button at the bottom of your screen. The questions are not going to be broadcast to the whole webinar chat. They're just going to come straight to us. So don't worry if you think you've got a stupid question. It's absolutely fine. Just feel free to ask away and we'll answer as many as we can at the end. Now, it's my job to make sure that everything runs on time. So I need to make sure that I leave enough time at the end, probably no more than 5 minutes or so, for a quick demo of how to buy some of the Xtrackers ETFs that we're talking about today on the InvestEngine platform. So hoping that once we've kind of wrapped everything up, we'll be ending the webinar at about 5:45. Now, before we get stuck in, I do need to mention the usual disclaimer that your capital is at risk whenever you invest, that this webinar is for UK clients only, and that none of this is financial advice. So with that, I'm going to hand over to you, Sturmius, in a second, but just before we get going with the questions, maybe you could kick us off by giving us a quick intro into who you are and who Xtrackers are, for those on the webinar who might not have heard of you before.
Yeah, sure. Thank you, Andrew. So my name is Sturmius and I'm a product specialist and I'm responsible for the development of index-based products. And this includes the Xtrackers ETFs. So what is Xtrackers? Xtrackers is the index investment business of DWS. And DWS manages approximately 1 trillion euro in assets. And Xtrackers is one of the biggest business lines of DWS, managing over 300 million euro in assets. And this is over all asset classes, so equity products, fixed income products, multi-asset commodities. And we have over 300 index tracking products on our platform.
Very impressive. Thank you very much. So let's turn to some of the questions now. I think kind of the main question that most people watching are going to be thinking is, what actually is factor investing? You know, why should I include factors in my portfolio? So maybe you could just kind of run through an introduction to what factor investing is, kind of in simple terms, if that's okay.
Yeah, happy to do so. So going to the next slide, I brought a little bit of a timetable of the developments in the factor research space. So I don't want to go into all of the details here. The idea is to give you a background of what actually happened and how that all have started. So most of that goes back to the 50s, 60s, when the first bigger breakthrough was made and research was published around equity factors. So the idea was to explain where risk and where return of stocks comes from. So what are the fundamental underlyings of this return and that risk? And over the time, additional factors were identified. And the scientists and researchers, they validated through thorough empirical analysis and research these factors. And they were found to explain persistent patterns in stock returns and in the risk of stocks. And these persistent returns tend to come up in different markets and also over different time periods. And all of this was picked up by institutional investors around the 2000s, when more and more investors basically started to incorporate factor-based index strategies into their portfolios. This was the institutional investor landscape. And then around the 2010s, the first factor-based ETFs became available. So this made factor investing and picking up these strategies also accessible for retail investors. And today, factor strategies are a cornerstone of many investors, of many institutional investors, of retail investors. And the idea is there, and why they are so famous is basically that they blend academic theory and research with the practical implementation in a portfolio or investment strategy. And I'm not talking about I'm not talking about products today. I'm purely talking about indices. And this is basically how the investment landscape made these factors available for retail investors. let us now look on the next slide into a few more factors in detail. So let me start with the first factor, and that's value. So value is the notion of value is inexpensive stocks. So the idea is that you select cheaply, or the index selects cheaply priced stocks. And what does that mean? So the stock value can be determined by some underlying fundamentals, and the idea behind that is that the investor would expect that the market reprices this asset and basically adjusts to that underlying value. And this is why these stocks are expected then by value investors or by value indices to pick up. Second factor I want to mention here is quality. So quality is described in the academic literature as basically capturing companies which have a durable business model and which have sustainable competitive advantage. And usually this comes with is also based on a sound balance sheet. So looking at stocks that have low debt, stable earnings, and show this is then described as like high quality metrics. Coming to the third factor that I want to mention today, which is momentum. So the idea of momentum is basically to benefit or to benefit from a continued trend in the market. So basically the winner of yesterday is also the winner of tomorrow. And academic research has shown that a strategy of buying stocks that have done well in the past and selling stocks that have done poorly generates positive returns. So there's a lot of research around momentum, and this is kind of a trend following strategy. The fourth strategy that I want to mention here is the minimum volatility strategy. So this is a low risk kind of approach. And the idea here is that through selecting stocks which don't fluctuate that much, you can overall increase your risk return characteristics of a portfolio. And the minimum volatility strategy can be used by tactical investors, so with a short investment horizon, to reduce a risk in a turbulent market or in a market downturn, but it is also used by strategic investors, which recognize that minimum volatility strategies have a better risk-adjusted return over the long run, and they allow to stay in equity, although not picking up the full risk and the full volatility that the normal core equity benchmark usually has. And last but not least on that slide, it's the low size or the size factor. And there were a lot of discussions recently and a lot of interest in alternatively weighted products. So if you think about alternatively weighted indices, so if you think about the MSCI World, so an index with 23 countries, developed markets countries, and then over 1,300 stocks, these broad market benchmarks are market capitalization weighted. So larger stocks have a higher share in an index, and then ultimately in an ETF product. And one option to reduce that or to move towards smaller companies is either by only buying the lower end of the market spectrum of companies, so not investing into large and mid-cap, or not selecting large and mid-cap companies, but to select smaller companies. So there's also, for example, MSCI World Small Cap Index, which in the end selects the smallest 15% approximately of the investable markets. Another option is equal weighting, and basically not weighting by the size of the company, but weighting by weighting equally. And the idea behind that size factor is basically that smaller companies, they tend to outperform larger companies over the long run. They have higher volatility, but they also have more earnings growth, higher growth potential, and so on. So that's the whole idea and the rationale behind the size factor.
So I just,
and now on
that point, just quickly, you might come to this later in the presentation, forgive me if I'm making you skip ahead. But you were saying the reason that small cap outperforms is, because they're riskier, they're small cap, they have higher growth, higher earnings, that kind of thing over the long run. But what about the other factors? What are the reasons that the other factors outperform? And are the reasons kind of similar, or are they different between kind of depending on the factor?
So that's a very good question. I think that's different per factor, but what usually and how the research came up with the factors in the first place is basically looking for outperformance of the broader market on the long run. So all of that factors were identified by looking at risk adjusted returns and then identifying underlying fundamental values, underlying construction themes of like that could actually describe this. And this can be seen on that slide very nicely. So on the right-hand side, on the right-hand chart, on the y-axis, you see annualized return. And the annualized return is basically how much did an index on an average year over a longer period like how much the index moved. And so the higher return, the better, right? For an investor. But what also someone or for someone that's looking into index growth. A second angle here is the x-axis. That's the annualized volatility. And just to give you like a easy to understand explanation of what annualized volatility is. So volatility measures how an index fluctuates, so moves up and down. And it's not mathematically correct, but one in easy terms can say that an index with a volatility of 15% moves up and down, or is expected to move up and down by 15% in a typical year. So that's like an easy to understand definition, and it means like the higher the volatility, the higher the upwards move and the downwards move that you would expect. So the more risk an index has, and what you can see here is a risk return chart over almost 30 years. So starting from 1998. So that was when factor indices or like the data for that can be found. And this is looking at the annualized return and the annualized risk of these indices. And moving up and moving left is basically increasing return and decreasing volatility. And what you can see here is that the orange dot is the MSCI World Index. So the broad market benchmark. And then all the other dots show the different factor strategies that are derived from the MSCI World Index. And all of them show better risk return characteristics than the MSCI World. I have not introduced these indices, but I will explain how they are constructed later. Let's now look at the next slide, and that's also answers part of your question, Andrew. This is basically, is factor investing a question of investment horizon? So is it important whether your investment horizon is 1, 2, 3, 4, 5 years, or if it's 20 years? And the core idea of factor research was long time horizon. So factors tend to work over very long time horizons. And that you can see here on the right. All of this like small dots are above the dark gray or above the gray area, which is the broad market return over that time horizon. And they all show additional return over that long time. But looking at shorter time horizons, that's exactly what also the research showed. There are macroeconomic cycles where different factors tend to not work or different factors tend to work very well. So there's two kind of investors looking into factor strategies. One is the strategic long-term investor, which believes in factor strategies and uses them for the long run. And then there's also factor investors that use these factor strategies to outperform the market, but they would be more interested in the shorter periods and selecting the right factor for the right macroeconomic environment. And I will touch base on that later.
Lovely, thank you. I think that's a really helpful introduction and has hopefully got viewers interested in these types of strategies. But I think what would be helpful now is if you could explain how these kind of theoretical factors are used to construct an index for each of the factors. Because I think the index construction is the important bit, right? Because the index is ultimately what a factor ETF is going to track.
Yeah, happy to do so. So there's a broad variety of factor indices out there. I would say there's like one core concept from MSCI, which is the most famous and also the most used factor concept out there, factor index out there. And the construction is relatively straightforward. So the index starts with a broad market universe. In this case, I'm talking about world factor indices. So we start with the index starts with the MSCI World, with all companies that are part of MSCI World. So 1,300 companies, 23 countries, large and mid-cap companies from developed countries. That's your universe. Next question would be how to select the companies that fit to your factor strategy. So how to select, for example, companies that show high quality characteristics. And this is done based on fundamentals of the company. So for quality, for example, or for quality, for example, you would look at the company's leverage, which is debt, the debt the company has over equity. And this is a value that you can derive per company. And then for this larger universe, you can, for example, select the companies that have low leverage. So you can sort them by leverage and you can select the top ones. In this case, these indices go a little further. So they use multiple fundamental values, so 2, 3, 4 fundamental metrics. And then these metrics are treated to treat some special cases. So some outliers would be treated, and then also to make sectors comparable, you would normalize or standardize that within sectors, and that makes it possible to compare all the companies, all the different companies in the different sectors against each other and sort them and assign them a quality score. And that's called factor score here or quality score. And when you have that for all the companies, you can sort them and you can select the top 100, top 500 companies by that score. These like standard, I would call them standard MSCI factor indices, they usually select a quarter of the market. So the 25% companies with the highest factor score, which currently is approximately 300. Those 300 companies would be selected in such a strategy. There are two reasons behind that. So one is you still get a good diversification. You still select a good amount of companies from the parent index, but you also have enough selection effect that you can definitely tilt your portfolio towards a specific factor. And to tilt that portfolio to a specific factor, the remaining 300 stocks that are selected, for example, they are not weighted as in a broad market benchmark by just the size of the company, but they are weighted by the size of market capitalization times the factor score. And this allows them to tilt even more towards companies that show high factor characteristics. Just one side note, this construction that I explained, that's pretty much the construction of the value strategy, so MSCI World Enhanced Value or MSCI World Sector Neutral Quality and Momentum. But the minimum volatility strategy follows a slightly different construction. I won't go into detail here, but the idea of the minimum volatility strategy is to use a complex algorithm to come up with stocks that in combination show low volatility. So the combination of that stocks should show low volatility characteristics. And this cannot or is more difficult to achieve by such a straightforward rules-based strategy, and that's why optimization is used there. Now, going into detail about what the factors actually are and how they are defined. And what you see on that slide is a very high level and high-level summary of how MSCI defines these factors in the index strategies. So value, for example, I already said value is supposed to select cheap stocks or determine how cheap a stock is. And how do you measure the expensiveness of a stock? There's a lot of theory around that. And one measure that can be used is the book to price or price to book value. And the book value is pretty much the assets of a company minus the liabilities on the balance sheet. And the idea is that the more assets you actually get by that stock, the more the stock should be worth. And another metric that's going into the value score is the price to earnings ratio, the forward price to earnings ratio. And the idea there is that the stock price basically appreciates the earnings of a company and should be a multiple or can be determined somehow by a multiple of the earnings. Now looking into quality. So quality, as I said, should should be basically sound balance sheet. How do you determine a sound balance sheet or a company that shows high quality characteristics? What research has found and what MSCI is using is a metric, for example, return on equity. And this shows actually how effective a company uses its investments to generate earnings growth. Another metric that's usually used for quality identification is, as I already said, debt to equity. So the leverage of a company, how much debt the company actually has. So this is one of the other metrics. Next metric would be earnings variability. So if you look at earnings growth, you would also be interested in how much do the earnings change year on year? So is it quite stable? Is the earnings growth stable, or is there a high fluctuation in earnings growth or in the earnings? Going to the third factor here, momentum. So bottom right, momentum, trend following strategy. How do you identify companies that show this momentum? And there are two metrics that I usually use for momentum, and it's looking at their price momentum. So today's price over the price 6 months ago or 12 months ago. So how good has the stock performed? Or what was the performance of a stock in the past 6 or 12 months? And as there can be two stocks that have the same performance, but the path to that performance was differently. They also use a risk adjustment there. So it's beneficial if a stock has shown a performance with a lower fluctuation in between. So that's why this is normalized. And I will skip the minimum volatility here, as this is a little bit of a different animal. And if you're interested in that, happy to answer questions around minimum volatility, but I won't go into detail now here.
Thanks so much. Thanks. A really good insight into how these indices are constructed. I'm just keeping an eye on time. What I do like is understanding why these factors outperform over the long, which you've done a really good job of articulating. But the other side of the coin is that they can also be used for diversification in a traditional market cap portfolio, right? So if you've got a few slides on that, I think it'd be useful to just give a quick run through of those.
Yes, very good point. And cautious of time, I'll rush a little bit. Let me talk a little bit about concentration. So probably most investors already have read about the high concentration currently in indices. So concentration is, and that's what the top chart here shows, is at elevated levels that we have not seen for 50 years. So looking at the weight of the 10 largest stocks in this MSCI World Index, they make up more than 25% of the index, which is levels that we haven't seen for 50 years. So concentration is high. That's the first message here. Second message is historically, and that's the bottom chart. So if we look at the top 10 stocks and the weight of the top 10 stocks at specific point in times, so around the 70s, 80s, 90s, and then look at the weight of these stocks at 10 years later, so a decade later, usually they lost weight. And that means the other companies outperformed these 10 largest stocks. So this is a good reason, or this is a good indication to think about, will the huge stocks and huge companies of today be also the winners of tomorrow? And historically, this shows that in the last decade, 70s, 80s, 90s, this has not hold true. Now looking at the next chart very briefly, it's about how to look at concentration. So I already said one measure for concentration is looking at the 10 largest constituents of an index. And what you see here is this MSCI World dot, 25% is what the 10 largest companies make up in that index. And the other dots here, S&P 500, for example, just as a reference, the 10 largest stocks make up more than 35% of that index at the moment. And then in between, you see the factor index strategies that I just explained. And what you can see is that especially value and min-vol currently, they have much less weight in the top 10 stocks than the world universe. But what you also can see is that momentum and quality currently are even slightly higher concentrated if you look at the top 10 stocks weight. Bottom here, just very briefly, there's a measure of how diversified a market is. And this is not used only for indices, but also for market share of companies and so on. And this is using that measure, you can calculate something which MSCI and also we call effective number of stocks. And equal weighted index usually has an effective number of stocks which equals the number of stocks in that index. And if an index is more concentrated, this number gets smaller. And what you can see here is that the MSCI World has an effective number of stocks of approximately 100, and the S&P 500 has only effective number of stocks approximately at 50 or so. And the factor indices are either more concentrated than MSCI World or less concentrated, but especially enhanced value and min-vol, I want to highlight here that they are much less concentrated and can be tools for more diversification. Jumping to the next slide, looking at a few drivers of that high concentration. And you probably have heard the phrase or read the phrase Magnificent Seven, and that is usually used for 7 large tech companies from the US. So Alphabet, Amazon, Nvidia, Tesla, Microsoft, and Apple. And looking at the weight of this huge tech stocks in different factor strategies or in different in the broader market. So top left is the broader market, and you see that these 7 stocks make up more than 20% of that index, and this has grown over the last year. So this is per month. Went back slightly to April or around Liberation Day, and then moved up again. And what you cannot see on that slide, I didn't include the value factor here. Didn't include the value factor index from MSCI here because it doesn't have any exposure to any of the Magnificent Seven currently. And what you also can see that momentum strategy, for example, depending on the price momentum of the stocks, sometimes picks up or picks some of these Mag 7 stocks, but currently, so since the May rebel, they don't have any Mag 7 exposure at the moment. So it actually rotates depending on the price momentum. So these factor indices are tools to reduce exposure to this Magnificent Seven.
Thanks. I think that makes a lot of sense. I mean, I personally really like how factors can both be viewed as kind of enhancing risk-adjusted returns, but also as diversifiers kind of in their own right. But we do know that no investing strategy can work well kind of 100% of the time. That's nothing outperforms forever. So could you just explain when investors can expect these factors to outperform and when they're more likely to underperform, please?
Yeah, happy to do so. And let us start doing that by looking at the market, the product market. So this is now a view of the European ETF market. Left-hand side, assets under management of world-based factor products, and right-hand side, the flow in these products. There's 2 observations which are quite interesting. So one is, in the last 10 years, since 2015 or so, the assets under management in factor-based world strategies has grown rapidly. So this is above 25 billion euro now, so above 20 billion pounds. And it's interesting also to see that it's not just one factor that collects money or one factor that's picking up the AUM here. It's pretty much all 4 or 5 factors that pick up money here and where products actually collect money from investors. And then on the right-hand side, it's quite interesting. This is the yearly flows into these products. So net new assets, so money basically flowing in these products per year. And what you can see here is very nicely this effect of macroeconomic cycles. So it's not that every year this all factors gain a quarter of the flows or get the same outflows. It's for example, last year, if you look at this light blue bar, last year many investors went into quality. So quality collected quite a bit. This year, it's completely different. Quality saw outflows. Quality products on the market saw outflows. This year, it's more about value and minimum volatility. So investors are, and I'm telling a little bit about that on the next slide, investors are preparing for a different situation in the economic cycle. So if we look at this chart, one can basically think of which factor works in which part of the economic cycle. And this is also what the research has picked up quite a bit on. So some factors tend to work better in some economic environments than others. And I think you have touched based upon this on a previous webinar and thought about like where in the economic cycle are we, or what metrics can you use to determine where we are in the economic cycle. And just to give you an idea, one can look at, for example, GDP development. So is the GDP growing? Are we in a recession? GDP falling? And you can also look at inflation. So is inflation coming down? Is inflation going up? So this is metrics that can be used to determine where in the economic cycle we are. And then historically, it was the case that quality and min-vol strategies worked well in economic contraction. And value and size, for example, worked very well and tended to work well during periods of economic expansion. Now there was a quite interesting move in quality, and this is that most of the tech companies picked up and got high quality metrics, because these tech companies that usually early in their cycle, they have unstable earnings, they are still growing, they're spending a lot, but this has changed. Some of these tech or Magnificent Seven companies are now in a position where they have like good earnings growth, like high and stable earnings. So quality picked up quite some of this Magnificent Seven. And this is why in this period where some investors are preparing for economic contraction, it's interesting to see that quality is not really picking up the flows. It's more the minimum volatility and value that's picking up the flows. And now, jumping to the next slide, let us deep dive a little bit into the minimum volatility strategy, which has been very, very popular this year. And there are three observations I want to make on that slide. So the top left actually shows performance of these two indices over the last 2 years in US dollar terms. And I highlighted here with this like blue circles, I highlighted some market downturns or like index downturns of the MSCI World Index, so the dark gray line here. And in the same periods, you see that this orange line, so the MSCI World Minimum Volatility Index performance, also saw downturns or downward movements, but they were at a much smaller scale. And that's exactly what the index aims to do and what's actually working. So in downturn periods, this does not pick up the full level of market downturn. And this is the historical observation of the last 2 years. Let us now look at the top right. So annualized volatility. And just as a reminder, volatility, so how volatile, how much like upward, downward movements within a year would you see in an index? And not mathematically correct, but over 1 year, what would you expect the index to do? Like either go up or down, but approximately the magnitude of that movement is for the MSCI World 15%. So this dark gray. And for the MSCI World Minimum Volatility Strategy, this annualized volatility is at approximately 10%. So there's definitely a lower volatility. And I put like 3 numbers here over 1 year, 3 and 5 year, but it's the similar pattern also over longer time horizons. And looking at the bottom right is now the maximum drawdown. So what is the maximum drawdown? Maximum drawdown looks at any point in time, from that time, like how much was the maximum the index went down. So for example, the 1 year maximum drawdown is looking for the peak of that index and then the trough. So what's the maximum the index has lost from any point in the last year? And this you can look at for 1 year, 3 years, 5 years, and so on. And again, what you see on the performance charts, but did not verify, is actually that the maximum drawdown for the last like 1 year, 3 year, 5 years is actually for the minimum volatility strategy smaller than for the broad market. So it actually works as intended. You also see that the minimum volatility index didn't pick up all the upwards movement. So if there's a strong upwards moving market, the minimum volatility strategy usually does not pick up all of that upwards movement. But for an equity strategy, it is able to pick up that upward movement and avoid some of the downward movement. So on a risk adjusted return basis, this index actually historically showed or delivered what it was intended to do. Let me make a few closing remarks before we come to the Q&A. And so what have we looked at today? So we saw that factors are used to explain the risk and the return of an asset and also of an index. What we also have seen is that style factors, they have delivered over the long run better risk and return statistics over the broad market. And we also saw that factor strategies sometimes exhibit higher volatility, and they also have prolonged periods of underperformance. So it's not that they work always in every year, in every period, in every macroeconomic environment. And what we also have seen is that factors favor some specific macroeconomic environments. So it's not that all factors behave similar in all macroeconomic environments. And last but not least, so we have seen this concentration rally in the last years, and this has been a tough environment for factor investing, excluding momentum, but still in that high concentration market phase, some diversification and some like allocation towards like less risk strategies, or to this like smaller companies or to companies that are undervalued and is definitely used by investors out there in the market. That was everything from my end. Now I'm quite interested in your questions.
Lovely, thank you very much. Hopefully everybody watching is getting really interested in the idea of factor investing. So in a second, I'm just going to run through which ETFs you can access on InvestEngine to capture these factors that Sturmius has been talking about today. We are coming kind of towards the end of the webinar, and I'm just conscious of time. So in the meantime, while I am going through the platform demo, please feel free, keep the questions coming. I can see we've had quite a few in the last few minutes. Keep them coming, and if we don't get a chance to answer them today, then we'll do our best to get back to you after the webinar. But for now, I have just requested to share my screen. There we go. Loading. Okay, here we go. So hopefully, I think everyone should be able to see my screen now. It's all looking good. Here we've got a dummy account to walk through. I'm going to go to my usual account that I do the demo stuff on, which is DIY1. This is having logged into your InvestEngine account on your web browser or your app. I'm going to go down to my portfolio here. Just a very simple one, 50% equity, 50% bonds. I'm going to click Add Securities. Then it's very simple. You get to this page here, which is the Browse Investments page, and you can just click the Xtrackers tile, and that takes you to the Xtrackers page, and you can see they've got a whole bunch of really good looking cheap ETFs on the platform. But we've been looking at some quite specific ones today. So what have we been talking about? We've been talking about value. So if we just whack value in there, we can see XDEV is the ticker for the MSCI World Value. So that tracks the index that Sturmius was talking about earlier. We've been talking about quality. And again, they've got the MSCI World Quality ETF in there. XDEQ is the ticker. And this is all recorded, by the way. So I know I'm going quite quickly through these tickers, but it'll all be uploaded to YouTube. So if you don't quite catch a ticker, then you can just watch the replay afterwards. We've got minimum volatility. So here we go. We've got XDEB as the ticker for that one there. And we've also got momentum, which is XDEM. Whoop. There we go. So I'm going to click that one. That was last on the list. Let's say I want to add this one to my portfolio. I'm going to click Add to Portfolio there. You can see on the top right here, that's now been added to the portfolio alongside my other two holdings. Quick continue. Now, how much are we going to put in here? Let's take 20% out of here, put 20% in it, and then we can see how that affects the portfolio. So because we've added a bit more momentum into the portfolio, we've increased the allocation to North America a little bit. We've increased the allocation to Europe ex UK, reduced Japan a little bit, and reduced Asia ex Japan as well. And you can see that how that also affects the kind of sector holdings as well. Reduction in industrials, increase in financials, tech, same in consumer. and then down to the individual holding level as well. So quite a nice kind of detailed view as to how that change affects your portfolio. But you can just click save and continue, you get a nice confirmation there. And if we scroll down to the portfolio now, we should see, here we go. We have a 20% target weight for XDEM. That's great. So we have a 0% at the moment invested in there. We have a target allocation of 20%. So I have this portfolio up and running. So what I would want to do if I was going to rebalance is I would just go options, rebalance portfolio, which is here, very, very simple. And then that would bring my portfolio in line with these target weights and it would execute all the trades for me. If you hadn't funded your portfolio yet, what you'd want to do is you can either click the invest button here, which is just a kind of investing a lump sum and just whacking how much you want to buy there. Or if you want to do a kind of regular investing plan, you can do this set up a savings plan button here. And then you can just say, okay, how much do I want to invest every month, and select the amount that you want to invest as well. So that is a very whistle-stop tour of how the platform works and the way that you can find these ETFs on the platform. But I can see we've had quite a few questions coming in, and we've got about 3 minutes to answer them, so we might go over a little bit. But let me stop sharing my screen and we can get stuck into them. Okay, bear with me while I have a quick look through the Q&A. Okay, nice, easy one for me to start off with. One for me. Are these products available within an ISA? Yes, they absolutely are. Fine for your ISA, fine for your SIP, fine for your GIA. Not a problem with that. Okay, question for you, Sturmius. This is a good one, actually. Can you combine multiple factor strategies, and how do you think it's best to do that?
Yes, that's definitely something we see that investors do. And we also analyze factor combination of indices quite frequently. So there's two options to that. Either like core satellite strategies, so reducing reducing the core index and then allocating a little bit to one or two factors. And then the other option is, or the other interesting thing is we're looking at barbell strategies or combining either 3, 4 factors or 2 factors. So one thing we have analyzed last year and did some analysis on was the value quality barbell. So basically a combination of 50% value, 50% quality, which showed quite interesting overall metrics. So you combine the quality companies, which is a little bit of the max 7 and all of that, and then also with value. So under companies that show high or like are underpriced from that perspective, and that showed basically that in such a combined composition, you would have both or like a broad variety of companies. So not only the 300 that one factor strategy would have, but you would end up with like 500 unique companies. But you also would have like interesting tilt towards like cheaper companies. You would also see that you would basically like increase your overall characteristics. That was quite interesting. So it's definitely possible and they can be combined. Let me pick up another question that is quite interesting, and that's the rebalance frequency. So historically, this factor strategies only rebalanced every like semi-annually. This has historic reasons. I mean, if you think about like other broad market indices, not MSCI World, they usually only rebalance once per year or twice per year. But as MSCI is picking up quarterly rebalance and has picked that up by their broad market benchmarks, they currently are in the stage of changing the rebalance frequency also for these factor indices. So they just end of August, the min vol and the momentum strategy starts to rebalance on a quarterly basis. And this is also an answer to the point of like price momentum. There's so many like strategic shifts out there. There's a lot of like market turbulences historically. So only rebalancing once per half a year or like every 6 months was just not feasible anymore. And that's why MSCI consulted on that and then decided to increase the frequency for these two indices.
Oh, that's really interesting. I didn't know that. Thank you. We have just got to time. I will answer one more question, and then we're going to have to call it a day. I can see we've got a few that we haven't managed to answer, but we will do our best to get back to you after this. But the one that I'm going to answer, because it's a nice, easy one, is how much the ETFs cost. And I'm not sure whether you're able to see that on the page there. I might have skipped over it, but they all cost the same. They're all 25 basis points. That means 0.25%. So all the Xtrackers equity factor ETFs on the platform are 0.25%. But I'm afraid that is all we've got time for. So yes, I can see we've got a couple of people that we haven't answered the questions. We will try and get back to you, although I can see that a few of them are anonymous, so we can't get back to you personally. If you want your question answered, you can email support@investengine.com with your question, and we will get back to you that way. But if you do want to find out more about any of the Xtracker ETFs that we've mentioned today, just click the Xtrackers banner at the top of our ETF range page. You saw me do that earlier, and you'll find all the details there. Okay, all that's left for me to do is to say thank you, Sturmius, for your time today. I think that was a really good discussion. And thank you to everybody who's dialed in for joining. I hope you found it useful and look forward to seeing you on our next webinar.